for this example, we're going to be using the US dollar against the Canadian dollar, right? Which was a bias I had shared from down here, right? I think it was the day after the bottom formed, right? So from here onwards, the bias was from the 3rd of July onwards, if I'm not mistaken. We'll check that right now. The bias was up only, right? And that is precisely what happened. And of course, this was a turtle soup, as are every single one of my entries. Now, let's begin with the filter we have. Number one, seasonal tendency. What is the seasonal tendency of the US dollar against the Canadian dollar at this time of the year? So the first element I'm looking at is time, right? Because time is more important than price. So the time tells me it's July. And in July, the US dollar against the Canadian dollar has a tendency to have a bottom form at the time of the year, right? At the same time, we have the DXY, the dollar index, which has a strong month of August, right? Which is an extremely violent seasonal tendency of the dollar, which can be exploited every year, and especially if you have a ranging market, right? Because if you have a downtrending market, and the seasonal tendency says it's time for a bottom, then you're probably going to have a short-term correction, right? However, if you're in a ranging market and the seasonal tendency is a violent one, then you can expect it to play out, right? If it's a bullish market, then it's bullish, and you expect a minimal retracement before continuation in the direction of the seasonal tendency, right? If that flew over your head, then you can repeat this once or twice. Now, the important thing is, if the DXY is going to rally in August, and we're reaching an important liquidity pool in July, then that tells me that there is an opportunity presenting itself. Notice how I'm not saying it's guaranteed we're going to make $1 million. No. All it is an opportunity presenting itself to me. It's a candidate for a trade idea derived from a bias, right? So, seasonal tendency, check. In this case. Inter-market analysis. At this point in time, we had pretty symmetrical market conditions, with the dollar also hitting a higher time frame key level on the monthly, right? And at the same time, the euro was hitting an important key level on the weekly and the monthly, right? So the correlation between the assets was intact, which indicates symmetrical market conditions, which are by nature a high probability. At the same time, you had USD JPY, the US dollar against the Japanese yen. It was also indicating signs of bullishness. We'll go and check each one right now. We have the DXY. At the same time, July, right? We are low the range lows, right? If you go look at USD JPY as well, then you had it also hitting an important key level on the monthly FVG, right? You had euro and pound both in July. Let's go to July. You had euro and pound in July. Also extremely overbought. And these symmetrical market conditions displayed the possibility of an existing opportunity, right? Which, of course, we capitalized on. Let's go back to USD CAD. So, the markets seem fairly symmetrical, right? Market profile, we are breaking highs and we are rejecting lows, right? We're breaking highs, and when we break highs, right, if the market is breaking highs, then when we dump below a low, we expect rejection and a rally, right? So the market profile is bullish. Worst case scenario, it's trending. Well, it was trending and is now consolidating, right? Excuse me. And the rules of the range trading, so this is a range low, range high, and the 50%, right? The rules of range trading dictate that the market is bullish down here, right? So everything seems in line, right? This was a pretty neat opportunity, and I'll show you a trade idea, a private one I had based on this bias, which was pretty incredible. And if you are presented with opportunities like this and you seize them once or twice a year, and you have the sufficient amount of capital with you, then you can live comfortably off of 2, 3, 4 trades per year, right? Now, if you're into Twitter and you're seeing all these clowns trading the 1 second chart and the 30-second chart, right, then that may sound insane, but it's not. If you have the sufficient amount of capital, which most of trading Twitter doesn't, they're a bunch of teenagers living with their mom, looking for clout and attention because their father never gave it to them when they were kids. So we don't go and learn from them, right? We're going to look to learn from people who are either extremely successful analysts or extremely successful traders with actual risk management and trade execution skills, right? Anyway, that was a little side rant. Back to the charts. At this point in time, US dollar against the Canadian dollar is showing signs of bullishness, right? We then go down to the 1-day chart. So on the weekly, the time is right. The inter-market analysis is right. The market profile is in favor of presenting an opportunity. And then finally, you have the higher time frame PDRA also in line, right? In this case, it would be not that. This is the one I used. The weekly down close candle, right? Now, in a bullish market, down close candles push price up and breaks through up close candles. In a bearish market, price will be pushed down by up close candles and will break through down close candles. All right, basic order flow probing. Here's an example. A downtrending market within the range over here. The up close candle over here, this one specific candle is pushing price down. And as soon as you see that, then you can expect it to break through the down close candle, right? Anyway, that's a topic for later. So the time is right. The intra-market analysis is right. The market profile is right. So now all we have to do is wait for a confirmation. So we had a rally off of the key level, right? And if you were unaware of the time, the correct time, then you would have kept a stop loss below this low and you would have got stopped out, right? But if you know the correct time, because the market's trading, really, it's all about time. Time and timing. The best traders you'll ever see place more importance on time than price. They place more importance on time than anything, really. So we hit the key level twice, right? So bounce, fade the bounce. And we dig through the old low with this one down close candle, right? All right, so what do we have here? We have a higher time frame key level, a higher time frame PD array, and we have two touches of the key level, right? As soon as we close above this down close candle, you are now ready to go. All right? And for those of you who attended the second private group I had made, which is about time in Turtle Soup, then you can see something in this specific candle which no one else can. And the same applies to the monthly candle. But now let's focus on this order block. So we dig into the old low, right? We close above the order block. As soon as you close above the order block, the entry is valid. From the wick to the open, it has a stubby wick, so you can wait for the open, right? So you enter here, potentially, and a stop loss is going to be over here. Below the low. If you're right, this stop loss should never be hit, right? Perhaps they'll go and accumulate inside the order block, then expand, right? That is valid. That's allowed, as long as they respect the 50% of the range of the candle with the wicks, right? And I'll post my personal trade I took over here in the group, right? It was this one, waiting for the up close above this order block. So the candle which dug this one specific candle is what I'm looking at, right? This one specific candle. It's not a bunch of candles. It's not a range. It's not ambiguous. It's very simple. Old low, tick. This candle digging inside the low, tick. Turtle Soup. And we break above the candle, another tick. It's a nice thick down close candle. As soon as this happens, we are now bullish, and we can then project our price targets over here, then over here, then over here, going 20, 40, 60, right? So if we go and turn the replay on, the most beloved tool of all hindsight Twitter traders. Right, so as soon as this happens and we close, right, now this might scare the ignorant, this move over here, which is we went too deep. Nope. As long as we're respecting the 50% of the range of the order block, then we are bullish, right? With a hard stop below the low. So it would look, a trade idea would look something like this. And I'm not your financial advisor, right? I'm not telling you to trade. I'm just telling you what an opportunity would look like. It was the one I took, right? So I'm just telling you a story, right? Entry here. This drawdown will scare the amateur, right? But the informed know that 50% is being respected with the bodies. That's all that matters to me, right? And of course the target is going to be these smooth edges, this double top, right? A lot of liquidity up there. And yeah, if you took this one single trade the last year with a decent amount of capital, then this is the only trade you would ever need, right? Now, the one I gave on Twitter, of course, was with a wider stop. The public one I gave was with a weekly stop. My private trade was done with the daily stop. You can go lower, right? 4 hour, nothing wrong with that. To each his own. And yeah, that concludes the Mega Trade review. Watch out for similar trade ideas to form next year, using the same principles, right? Using this, right? You yourself, you don't need me. You can frame a bias for the next couple of weeks, the next couple of months, right? You can easily do that using this framework you have over here, right? And that concludes the review, right? I hope you enjoyed it. And study well and compare the different trades that happened last year based on this. And one last observation I'd like to include is the higher time frame key level, right, leading to a lower time frame expansion, right? Just to take a mental note of that sentence. And that's all for now. Hope that wasn't too long. And good luck and good trading. And stay tuned for the 8th of January.